On March 10, 2023, Silicon Valley Bank collapsed. Not over months, not over weeks. In 48 hours, $42 billion vanished from its accounts. Customers didn't line up outside branches. They didn't wait for business hours. They opened their phones at breakfast and moved their money before lunch. By the time regulators in Washington understood what was happening, the bank was already dead. This isn't a story about one failed bank. It's about the fundamental mismatch between two speeds. Money now moves at the speed of fiber optic cable. Governments move at the speed of committee meetings. And that gap is getting wider. Right now, $3.7 trillion moves across borders every single day. Most of it electronically. Most of it in seconds. The entire global economy has become a system where capital can relocate faster than any authority can respond, which raises an uncomfortable question. If money moves faster than the people supposedly regulating it, who's actually in control? Let's rewind. For most of human history, moving money was physical and slow. Gold had to be loaded onto ships. Paper currency traveled in locked boxes. Even in the 1980s, international bank transfers took days, sometimes weeks. There were natural speed limits built into the system. Those limits also gave governments time to notice problems, time to respond, time to coordinate. Then came the internet and SWIFT payments and high-frequency trading and mobile banking apps. Suddenly, the speed limits disappeared. Here's how fast things actually move now. A currency trade on the foreign exchange market executes in 11 milliseconds. That's 11 thousandths of a second. Algorithms are making buy and sell decisions faster than a human being can even perceive them. A venture capital firm in California can wire $20 million to a startup in Singapore, and that money arrives before the coffee gets cold. A hedge fund in London can detect a policy announcement in Japan and reposition a billion-dollar portfolio before the press conference ends. The entire global financial system now operates on a timescale measured in microseconds. Governments do not operate in microseconds. The Federal Reserve meets 8 times a year. The European Central Bank meets every 6 weeks. When a crisis emerges, finance ministers have to schedule calls, regulators have to draft memos, parliaments have to convene hearings. Even emergency measures take days. During the 2008 financial crisis, Lehman Brothers collapsed on a Monday. The emergency rescue package didn't pass Congress until the following Friday. That's 5 days. In modern financial terms, that's an eternity. Trillions of dollars can relocate in 5 days. Entire markets can freeze. The Silicon Valley Bank collapse exposed this speed gap in brutal clarity. On Wednesday, March 8th, the bank announced it had taken a loss on some bond sales. Nothing catastrophic, just a normal disclosure. But venture capitalists started texting each other, then tweeting, then advising their portfolio companies to pull funds immediately. Within hours, founders were panic withdrawing, not because they had new information, not because anything fundamentally changed, just because everyone else was moving fast, and being slow meant being last. By Thursday morning, customers had requested withdrawals totaling 1/4 of the bank's deposits. By Thursday afternoon, regulators were trying to figure out what was happening. By Friday, the bank didn't exist anymore. Traditional bank runs used to require physical proximity. You had to hear a rumor, walk to the bank, stand in line. That friction gave authorities a window to intervene. They could close the bank temporarily, issue statements, coordinate a rescue. Digital bank runs have no friction. Someone tweets, 10,000 people click transfer funds from their couch. The panic spreads at the speed of group chats. And here's the disturbing part. The money doesn't even leave the banking system. It just moves between banks faster than regulators can track it.
The system becomes unstable, not because capital is disappearing, but because it's moving too quickly to control. This speed asymmetry shows up everywhere. In 2015, the Chinese stock market crashed. The government responded by literally banning selling. They froze accounts, suspended trading, arrested short sellers. Desperate moves by a government that couldn't keep pace with electronic panic. In 2016, India's Prime Minister announced that high-value currency notes would be invalid by midnight. The goal was to catch tax evaders off guard. But within minutes, people were using mobile payment apps to convert their cash into digital assets. The black market adapted faster than the policy could land. In 2022, when Russia invaded Ukraine, Western governments announced sanctions. Those sanctions took 72 hours to fully implement. In those 72 hours, Russian oligarchs moved an estimated $20 billion into jurisdictions beyond reach. The crypto industry understood this speed gap early, not because crypto is faster than traditional money, it's often slower, but because crypto operates outside the infrastructure governments can easily touch. When Canada froze bank accounts linked to trucker protests in 2022, Bitcoin donations surged, not because Bitcoin is untraceable, it's not, but because it takes governments longer to figure out how to block it. That delay matters. The entire appeal of decentralized finance isn't about ideology, it's about speed, about moving value before anyone can stop you. Every regulatory framework assumes there's time to react. Crypto deliberately eliminates that time. Central banks know they're losing the speed battle. That's why nearly every major economy is now researching or piloting a central bank digital currency. China already has one. The digital yuan allows the government to track and control transactions in real time. The European Central Bank is testing a digital euro. The Federal Reserve is studying a digital dollar. The pitch is always about efficiency and inclusion. The subtext is control. Because if private money moves faster than government money, governments become optional. And no government wants to be optional. But here's the irony. Even digital currencies controlled by central banks won't solve the core problem. They'll make government money faster, but they won't make government decision-making faster. Let's zoom out. What we're really talking about is a fundamental shift in power. For centuries, governments had something close to a monopoly on violence and money. They controlled armies and currencies. Those two things gave them sovereignty. The monopoly on violence still mostly holds. The monopoly on money is evaporating. Not because governments are weaker, but because the technology of money has outpaced the technology of governance. A government can draft a law, but by the time that law is debated, passed, and enforced, capital has already rerouted around it. Algorithms don't wait for legislative calendars. Markets don't adjourn for holidays. This creates a world where democratic accountability becomes almost impossible. How do you regulate something that moves faster than you can perceive it? Some people argue this is good, that slow governments are the problem, not fast money, that capital should be free to move wherever it's treated best, that speed is a feature, not a bug. Maybe, but speed also means fragility. Systems that move too fast become impossible to stabilize. A fire spreads faster than firefighters can respond. A virus spreads faster than vaccines can deploy. And financial panic spreads faster than any central bank can contain. We've built a global financial system that's optimized for velocity, but velocity without control is just chaos with a delay. Every bank run, every flash crash, every sudden capital flight is a reminder that speed creates risk. And right now, we're managing that risk with institutions designed for a slower world. There's no obvious solution here. You can't uninvent technology. You can't slow down the internet. And you probably don't want to. Speed has benefits. Faster payments mean lower costs. Instant settlement means less counterparty risk. Global capital flow funds innovation. But we're running an experiment in real time, an experiment to see if governance can adapt to a world where it's always reacting, never anticipating, where by the time a problem is identified, analyzed, and addressed, it's already evolved into something else. Some economists think artificial intelligence might help, that algorithmic regulation could match algorithmic trading, that governments could deploy their own high-speed monitoring systems to keep pace. Maybe, but that raises other questions about who controls the algorithms. Here's where we are. Money moves faster than laws, faster than treaties, faster than emergency meetings or press conferences or congressional votes. It moves faster than the institutions we built to manage it. And every time there's a crisis, we see the same pattern. Markets move, authorities scramble. By the